What's up, everybody? Welcome back to the channel. We're going through Blast the Banks. We're hitting all the major ones, or at least in my eyes, the bigger ones that are US centric, and talking about the solvency issues they have by just simply looking at their balance sheet, looking in the notes, and all the other typical things that are provided to the public for the 930 time period. So, again, our primary things we're looking at are cash to deposit liabilities, federal home loan bank loans, how many securities they have versus their stockholder equity, and a few other components to see, can these banks get out of these situations? How much flexibility do they have? And if rates continue to rise here, are they really in deep trouble of their equity value disappearing, going to zero? So, again, I'm trying to shorten these up a little bit, so let's get right into it. As you can see in front of us right here, we have Fifth Third. And so let's hit all the points. So we're jumping down to the balance sheet first. And based on my notes, it looks like we're going to page 62. But here, we'll jump via this way. Oh, yeah, like I always like to talk about the character test by management. In this situation, Fifth Third puts their management discussion first. It is right off the bat, it is at the top of the report. That's what you want to see. You want to see management talking about what's going on and laying all their cards out on the table right off the bat. The last thing you want to do is have it at the bottom because it means, or at least it sort of implies, or at least you and me would think, they're hiding information. So we give Fifth Third credit here. Their management seems to be a little more transparent and open because they're giving you all the details right off the bat. But again, like I said, let's go to the balance sheet here. And it was page 62. Let's just make sure. And of course, it is not. Here, let's scroll all the way down here. All right, here we are. And I am sorry. It is page 63. I will update that. So, yeah, again, all the typical things we've gone through with the other banks, let's go through this one. So, first, we have cash balances. So, as you can tell here, Fifth Third's cash is 21 billion. So, a smaller bank, they have 212 billion in assets. So, a little bit on the smaller end compared to the other ones we've already looked at, but still a pretty large bank. 212 billion, that's not very tiny. But compared to their deposit liabilities of 167 billion, they have about 13% cash on hand to pay those deposits. So not the worst we've seen, which was Truist, not the best we've seen. So yeah, I mean, would you like to see this up higher? Absolutely. It would allow clients and customers to remember that they're okay. They can go get their money. The bank isn't going to have to raise outside capital to fill their deposits. And I feel comfortable keeping my money at Fifth Third Bank. Okay, and then again, like we talk about too, because this was the primary facility used to bolster the liquidity of these banks, which was these federal home loan bank loans. And yes, Fifth Third does have them. However, they're pretty small. They're only 4.25 billion. That is on page 113. Trust me on that. It's not broken out here on the statements. It would fall into short-term debt, which is somewhere over here. But yeah, trust me on this. And again, I'll leave all my notes in the X comments and everything else. But for $20 billion in cash, roughly, they only needed $4 billion to bolster their liquidity, at least in their mind. I also believe too that it decreased a little bit. So yeah, Fifth Third, not as dire maybe as you could say from other banks' standpoint. And I'm going to show you why I think that they're on a better course than other places. So again, moving down, so we've hit on the deposits and everything. Now let's talk securities. So as you can see here, all of, at least the majority of the bank's security portfolio is in available for sale securities. So these are not held to maturity, meaning they can dump them and they're already flowing through the income statement. There's not other comprehensive income losses that are going to continue to just stack up if rates keep rising. Fifth Third has given themselves more flexibility where if they need to dump these securities, they don't have to do a accounting change and go through all that and have all these losses come onto the books, at least above the line and not hidden below. So much better situation in terms of financial flexibility. And that's why I think they don't need as many federal home loan bank loans for their liquidity purposes. They're going, okay, we can dump these securities if need be. We have the financial flexibility there. It's not ideal that we have losses on these, but we can dump them if need be. So Fifth Third, already off the bat, as you can tell, starting to look a little better from a flexibility standpoint from some of the other banks that we've looked at already. All right, moving down the list, I'm going to try and stay on the balance sheet here first before we get into, the nuances of the security portfolio and everything. Um, let's talk just about their loans really quickly. So they have, where are we looking here? They have 120 billion in loans, and their shareholder equity is 16 billion. And again, too, look at how much they have in available for sale securities. So roughly 49 billion. So let's touch back on the securities. So based on my analysis, the value of those securities would have to come down 33% in order for the equity value to get wiped out. So not ideal. Again, if rates keep rising, that could very easily happen. However, it's not as anemic as some of the other ones. I believe Schwab was only 14%. So this company, and again, too, they can fire sale dump it, these securities if need be, to make sure that their equity value doesn't go to zero, and they can continue to fight another day and yeah, be able to manage these things a little bit better on a balance sheet basis from the financials that you can see, so they're not, so people don't realize what's going on and say, oh my gosh, on paper this thing has no equity value, the shares are worthless. So yeah, again, Fifth Third, much better situation, much better flexibility in terms of their loan book to their shareholder equity. They have, again, shareholder equity is only 16, 17 billion. Their total loan book is 120 billion. So pretty large kind of leverage profile there. Not ideal, but again, um, if the credit portfolio goes down because we have economic distress, you would think rates would come down with it. So there's going to be an offset there, and they have all these available for sale securities. The value of those will go up, the shareholder equity will go up, and they will be supported in that scenario, ceteris paribus, all things held equal, and if things act normally. So, yeah, again, like I continue to harp on here, Fifth Third appears to be in a much better situation. Again, the Federal Reserve is raising rates, trying to eliminate inflation. Why? Because higher inflation leads to higher rates. So these banks, because of their security portfolios, all have interest rate risk. There's no credit risk yet, or if there is, it's minimal. There are some credits that are going bad, but it's not near how bad of the situation is from the security, standpoint. So again, the Fed is trying to take pressure off the system, so get these bad loans or these bad securities to go up in value, and they're trying to do that by hurting the economy, thus driving interest rates down, thus improving the solvency of these banks. And then if that happens, the reason why they're cutting rates is the economy's getting worse. So that would mean that credits would get hurt. However, like I've talked about in other videos, due to 2008, they have more robust parameters in place to deal with all of this. And again, they're trying to take the pressure off the system and put it on the people. That's the whole game here. The whole game, they're not going to sacrifice the system for the people. They need these banks. Why? Because all of these securities are backed by the government, and they can't have egg on their face that the government let all this happen, and now the government is on the hook not only for these lending institutions again, but also for all these securities that they originated during COVID and prior to COVID, when rates were in a completely different situation. So again, that is the main theme to all of this, and why the Fed is in this position, and they're just going to keep raising until they break this thing, and they might not even break it. So that's kind of the the known unknown out there, and what could cause issues. So, and again, that is a white swan, not a black swan. A black swan is an unknown unknown. A white swan is a known unknown. So it's a white swan. If that situation happens, who knows how this thing's going to play out, but you know that that could be a possibility if rates continue to rise. All right, and now let's get into the security concentrations, just so I can provide some value on that. and then we will move on to the next bank. We're going to page 75. And so again, so far I've been giving this one decent grades because they have more flexibility. They still have some of those stains of those federal home loan banks, federal home loan bank loans, but it's not near as bad. Okay, here you go. And again, this is just showing that all of their securities portfolios and available for sale. Here's their held to maturity. Notice there's nothing here. There's nothing there. Nothing at all. It's, very small. So everything is trapped up here. And what is the bulk of their securities in? Agency paper, mortgage-backed securities, primarily commercial mortgage-backed securities, but they also have them in residential, which is this line above right here. So again, government guaranteed paper. These are they've lost $5 billion and $2 billion roughly on both of these right now. And so, yeah, that's what they're trying to prevent. They're trying to make those securities be worth more by driving interest rates down and shifting the pain off the system, because this is the system, and onto the people, which is the credit book. And so, yeah, the concentration here is 50% in these commercial mortgage-backed securities, roughly. So that's their concentration. We all know what's going on in the commercial real estate market, especially more with office right now. There's some other sectors that are performing much better, but you know where office is at. And these loans, they could get very interesting too from that standpoint. But again, they're government guaranteed. But we're getting too outside of the scope of this video. But know that that's also a factor in some of these situations as well. Okay, now let's go down to see how long the repayment is on these. How long are these going to be outstanding? And for that, we have to go to page, it's saying 75 here. It's saying I missed it. Let's take a look here. Give me 1 second. Let me just find it. It's usually somewhere down here. Nope, that's 12 months. Nope. Come on, where are you? Is this it? This is probably it right here. Nope, we're in the credit book. Hold on 1 sec. See, isn't this fun? This is what happens. You get all your places finally lined up and everything, and then you're off on. Oh, here we go. Here it is. I went right by it. All right. Yep. Sorry. Page 76 here. So again, it's giving you all the time frames right here, how long these securities are due, or how long it's going to take you to get all the bulk of your cash flows. I guess I'm going to say this is duration based, because it kind of is. Duration is a proxy for the amount of time it takes to get all your cash flows. It's not ideal. People do other things in bond trading that is not duration, because duration has issues with it and it doesn't perfectly match. But again, that's outside of the scope of this. So let's look at this. And again, I've been basing everything off of securities that are maturing 5 years or later. That's been my primary way of looking at these things, because I think 5 years is a long time. And typically that's how they're categorizing these things. As you can even see here, you have 1 year through 5 years, you have 5 years through 10 years, and then you have 10 years after. So as you can see here, a decent amount of their securities are greater than 5 years. I have it at 70%. 70% of their available for sale securities, which is the total security book, is longer dated than 5 years. And that is a lot. There's a lot of risk there. And again, if the long end of the curve keeps moving up here, these securities are going to get more underwater and more in trouble. So does this bank have the ability to sell these securities from an accounting standpoint because of the accounting treatment they're using? Yes. But due to the actual way these securities are from a duration of cash flow basis, how long the maturities are, do they necessarily want to do that? And is it harder for them to offload these securities given their duration? Absolutely. They're longer dated and they're low yielding. The yield on these, which is on page 14, is 2.86. 2.86. That's how much these securities are yielding. And again, if you're in short-term paper right now, 1 to 3 month T-bills, you can make 5.5%. So yeah, not good. I mean, you can almost make double the return in cash, and they're 10 years, 5 to 10 years out, and even greater on the maturity curve, and they're making half of what you're making in cash right now. So again, this is a big failure by them. They missed the mark. They sort of stretched out into that longer duration like a lot of these other banks have. And yes, they have the flexibility to dump the securities, but they don't want to dump them because they're underwater and they need to get the value up. So that's what's going on with Fifth Third here. A little different. Let's see if I missed anything. Their common equity tier one capital ratio is 9.8. Not the worst we've seen, not the best we've seen, sort of in the middle of the road. Still not ideal, still not great. I know they would like to get that up higher. So, yeah, I would call this one meh. It's mid, as the kids say. Not the best, not the worst, but definitely has some weaknesses. And again, as I said here, do they have federal home loan bank loans? Yes. Is their liquidity somewhat distressed? Yes. Are they somewhat, they're not insolvent, but are they having solvency issues? Yes. But do they have the flexibility from an accounting standpoint to get out of it if they have to do so to save the ship? Absolutely, they do, because they're all available for sale. So, Fifth Third, again, it's mid tier, not the best, not the worst. Look at my comments and everything, all the information I'm going to provide on the Twitter post that'll help you better understand where I'm coming from, why I'm ranking it sort of in that middle tier and not on the lower end or the higher end. But yeah, hope you enjoyed this video. Like, subscribe, comment, throw more suggestions out there. Happy to do other banks that kind of fit this criteria. I kind of like to do the bigger ones because they were ones that were more susceptible to taking on lots of securities due to all the stimulus money getting pumped into the system. But yeah, thanks so much for watching. Really appreciate it, and I'll see you for the next video.